All right, in this breakdown, we're going deep. We're conducting a forensic analysis of a real giant in Sri Lankan industry, Lanka Tiles PLC. As your Optivest analyst, our job is to cut through the noise and get straight to the data, looking at the company's strategy and its real financial health.
So what's our goal here? It's pretty straightforward, really. We're going to dissect the performance, pinpoint the pressures, and explore the potential futures of this company. For any retail shareholder out there, understanding these moving parts is absolutely essential, and that's precisely what we're here to do.
Okay, so here's how we're going to break this down for you. We've got 4 key areas to investigate. We'll start by looking at the company's recent golden era. Then, we'll dive into the crisis that it's facing right now. After that, we'll analyze how management is fighting back. And finally, we'll explore 2 very different paths its future could take.
You know, to really get a grip on what's happening with Lanka Tiles today, you have to rewind the clock a little bit. We need to look at the very unique market conditions of the last few years, which was a period of, well, almost total dominance for them. Okay, take a look at this number. 46%. What is that? Well, that was the company's staggering gross profit margin in the 2023 to 2024 financial year. Let me tell you, that is a level of profitability that's just incredibly hard to hit in any normal competitive market.
So, the big question is, how on earth did they pull that off? The answer? It was kind of a perfect storm, created by economic policy. With tile imports basically shut down, Lanka Tiles suddenly found itself in what you could call a virtual monopoly. This meant they could crank up production to meet all that pent-up demand and, crucially, charge premium prices.
But here's the thing about golden eras. They don't last forever. And for Lanka Tiles, that era is definitely over. Today, the company is caught in what we're calling a pincer movement. Think of it like a two-front war that's squeezing its profits from both sides.
So on one hand, you've got Threat 1, the market flood. The import bans were lifted, and bam, the market was swamped with cheaper tiles. A lot of these came from importers who aren't even registered for VAT, which creates a totally unfair fight. And then, hitting them from the other side is Threat 2, the cost shock. Suddenly, the price of energy and raw materials went through the roof, making it way more expensive to produce a single tile. So let's go back to that magic number for a second, 46%. Remember that? That was the peak, the absolute high point during those monopoly years.
And this is the reality today, 33%, a total collapse in their profit margin. And the wildest part, this happened even though they were actually selling more tiles by volume. Think about that. They're selling more, but making way, way less on every sale. And if you want to see just how intense that cost pressure is, just look at this chart. Energy and raw materials, which used to be manageable, now make up a whopping 70% of the total cost of production. 70%! That's the direct fallout from those global energy shocks.
Okay, so the company is getting squeezed hard. The big question is, what is management doing about it? Are they just sitting there? Nope. Our analysis shows a really clear, deliberate 3-part counterattack. It's a strategy designed not just for survival, but for a real recovery.
First up, they're going upscale. They're introducing premium products like these huge Majestica tiles to get out of the brutal price war at the low end. Second, they're not just waiting for the local market to save them. They are aggressively building an export mode, especially into the United States. And third, they're getting smarter on the inside, using serious tech like SAP and AI to slash waste and become a much leaner operation.
And listen, don't just take my word for it. This strategy comes right from the top. The chairman himself has made it crystal clear. Exports are absolutely critical. It's not just about growth, it's about selling the huge amount of inventory they've already produced.
Now, this is maybe one of the most important points in this whole analysis. While their profits are getting hammered, their balance sheet is actually rock solid. Their gearing ratio, which is just a fancy way of saying their debt level, is only 12%. That gives them what we call financial oxygen, the breathing room to actually execute this turnaround plan and outlast competitors who might not be so fortunate.
All right, so this all leads us to the big finale, the future. And from where we're standing, there are 2 very, very different roads ahead for Lanka Tiles. It's either going to be a powerful rebound or a really painful relapse.
The company's fate is basically chained to the health of the local construction industry. If it booms, let's say by around 19%, that's the best-case scenario. Lanka Tiles can use its new export business and leaner operations to get its profit margins back up near 40%. But if that sector contracts heavily, we're in the worst-case scenario. The company could fall into a liquidity trap where it has to keep borrowing more money just to stay afloat, and that debt just eats away at any potential profit.
But there's a huge wild card in all of this, a global threat that could throw their entire recovery plan right out the window. We're talking about a potential geopolitical crisis in the Middle East, maybe around March 2026. Something like that could send energy costs soaring all over again and completely wreck global supply chains.
And that potential crisis brings us right to this gigantic number, 7.69 billion rupees. That is the value of the tile inventory that Lanka Tiles is sitting on right now. The success of their entire strategy hinges on their ability to sell all of that stock.
So this leaves us with the final critical question that every single shareholder needs to be asking themselves. In a stable world, this massive pile of tiles is a fortress, a strategic asset that lets them meet any demand. But in a world of skyrocketing energy costs and broken supply chains, could it become a prison? A massive liability that traps capital and bleeds the company dry? That is the multi-billion rupee question.